All right, so look at the 2018 published account. So published account's generally a grouping question. You're looking at trying to group figures together. There's no real, well, there's a few workings, but no major real workings in it. So the important thing for published accounts is that you lay out your workings page appropriately. So again, this should really nearly become part of your skeleton. That we lay out cost of sales, distribution, admin, other operating income, intangible, tangible, and revaluation. I'll skip a bit between them. Debtors, taxation, other creditors, and then we've a couple of little workings. But you'll see I've got that all laid out. Now the reason for that is in our skeleton, you've got to do a trading profit and loss account, but it's only with headings. So normally, as you know, in a final account, you have cost of sales, which would be opening stock, purchases, carriage in, closing stock. You don't have any of those. You just have cost of sales. Distribution costs. You might have depreciation of vehicles. You could have distribution costs themselves. They normally be selling and distribution, so commission, all that sort of stuff. That's just replaced with just a heading, and then the same admin where you'd have depreciation of buildings, administration, rent as an expense, whatever it might be. We link them all together. Same in your balance sheet. Instead of having buildings and vehicles and the depreciations of such, you've just got an answer for tangible fixed assets. So as a result, we have to do an awful lot of grouping together. All right, so the really important thing, as I said, is the layout of our question. All we do from that point is just start at the top and you put in everything where it goes. So if I'm saying to you that everything has to go somewhere, basically we just put everything where they go. So depreciate, delivery, start at the top, work your way down. Don't worry about workings for a little bit. Just a couple of things to note. You will revalue buildings. So somewhere in the question, it's going to tell you that buildings are going to be revalued. So what does it say? No. At the end of the year, the company revalue its buildings to 850,000. That 850,000 should, I would suggest changing that number from 760 to 850 in the question, and keeping things simple from there. So I'm going to work mainly off my workings page, but there'll be a few times when we don't have to. So delivery vans, right? Delivery vans we know are a tangible fixed asset. Now for you lads, you don't have to write in the words. I'm only going to write in the words for the sake of notes. Okay, so delivery vans are 280, and depreciation of delivery vans would also be intangible fixed assets as a minus. So that's minus 116. Okay, because you don't have you're lumping all of these things together, so therefore you have to lump their depreciation and so on together. 6% investments purchased on the 1st of the 4th 2017. So my investments, they're going to go straight in 300,000. Okay, on top of that, I'm going to work out what my investment income is. Now this is one of my very few workings on this question. So it's 6% of 300,000. You got them on the 1st of the 4th, so you have them for 9 months. And that's 13,500. Now, that 13,500 has a spot in the question. Investment income, 13,500. So I'm going to put it in. You'll notice that basically I used the second column for all of these. Buildings at cost. Now, that was the one I said you're going to change to You're revaluing it to 850. So I'm going to put in 850 in my tangible fixed assets. And I'll worry about the rest of it after. Okay, so that's that one. Investment income, 84. That's the investment income we receive. So that's used to work out investment income due. So we're supposed to get 13.5. We've received 8.4. And that'll give you 5,100 due. Now, investment income due would normally, in a trading profit and loss account, go into your current assets. It'll still go into your current assets, but you'll see in our skeleton, you've only got stock, debtors, and bank as your current asset options. So it's not stock, it's not bank. So it's money owed to us, so it goes into debtors. So the 5,100 goes into your debtors. Okay, so that's that one done. Debtors then, 139. Well, debtors will go into debtors. And then you've got creditors. Now, creditors has a spot in its answer. So, trade creditors, 108,000. So that's the only thing that goes into trade creditors. Every other type of creditor goes into other creditors, so that can go straight in. Stock is your opening stock. So opening stock is in cost of sales. Patents, 42,000. That's our intangible fixed asset. Now, you have to do a bit of a working on this. We'll see it later on. Admin, well, admin will go into admin. And distribution will go into distribution. Purchases, 1170 will go into cost of sales. And sales, nice easy one. You don't have to do anything with it. It just goes straight in. Unless there's sales returns. But 1870. I'm going to put it in there for the time being. Okay, 1800 300. Carriage in, cost of sales. And returns in. Right, returns in is sales returns. Now, you know it's sales returns because it's on the opposite side of sales. So that 20,300 has to get taken away from sales. Now, that would have been new to the lads in 2018, but not really because you did it at junior cert, and it should be straightforward enough to understand what returns in are. So they have to go somewhere. So their sales returns 20,300, so it goes down to 1.78 million. Rental income is 28,000, so that's other operating income. Profit on the sale of land. Well, there's always a spot for profit on the sale of land in a trading profit and loss account, so it can go straight in. Profit on the sale of fixed assets is 87,000, unless there's more than one profit or combination. It can go straight in. Dividends paid, 55,000. Can go straight in. Bank can go straight in. It's got a spot. 82. VAT 34.2. So VAT is taxation and charges. So it just goes down here. All of these things just going in once. They can only ever go in one place. Profit and loss first of the first 2017. So that goes in to our answer, 42,500. You see it's on the debit side. That makes it a minus. It means you've accumulated losses of your business. If it's a credit, you would add it on. Your two share capitals, ordinary and preference, so 600 and 120 is 720. That's your called up share capital, so 720. Provision for bad debts. Now that goes in your debtors, all right, as a minus. So just as normal, debtors minus bad debt provision. So minus 28.5. Debentures can go in. So 7% debentures are 300,000. Obviously, you put in the year like so. Discount, it's on the credit side, so it's other operating income. And debenture interest paid, used to work out debenture interest due. So I'll do that working now. Your debenture interest is 7% of 300,000, which is 21,000. Okay, so that'll go in my answer. For interest payable, minus 21,000. And then your debenture interest due. So you've paid 13.3. So that means you've still got to pay 7.7. Okay, so debenture interest due, that needs to go into your other creditors. So normally go in your balance sheet in creditors as debenture interest due. There's no spot for it in a published account. It's not a trade creditor, it's not dividends due, it's not tax due, so it has to be other creditors. So that's 7.7. Goes in. So that's everything in once from there. We're going to end it down to the bottom now. And all of these, there's a couple of little workings that to go in, but all of these go in twice, once on each page. So stock, 86,000. So that goes in your cost of sales on your first page as a minus, obviously, and then it'll go in your current assets on your second page. So that's that one. Second one, patent was acquired for 63,000. It's amortized, which is written off over 9 years in equal installments, and it's to be included in cost of sales. So 63,000 divided by 9 is 9 sevens or 63. So 7,000 is our patent written off, and it's telling you that that has to be included in cost of sales, and then these go down by 7,000 here. And that's 35,000. I know what the answer is there. Okay, so that's that one. Provision to be made for debenture interest due, we've done that. Investment income due, we've done that. So auditors fees, 16,000. So auditors fees are admin. Directors fees, they're admin. Okay, and corporation tax goes in corporation tax on the first page. Minus 32,000. So they've all gone in once on the first page. They then have to go on to the second page. So you're providing for them, which means you haven't paid them. So they're liabilities. So the first two, auditors fees and directors fees, okay, the first two of those are other creditors. The corporation tax, it's a creditor, but it's not it's a specific type of creditor, so it's taxation. So the taxation of 49,000 goes in your tax. Sorry, put the word in there. So 49,000 goes into your taxation there. Included in distribution costs is a receipt for patent royalties. Now, this is exactly like investment income, patents incorporating investment income, or what we saw from the mock question 1 where distribution, some sort of cost included an income. To get rid of this, you have to add it on. So included in distribution cost is 15,000 for patent royalties. Patent royalties is an income. So it included in this 144,000 is a credit. Well, it's not actually in the 144,000. It's in a different number. So distribution costs is 159,000, but there was 15,000 patent royalties, which is on the credit side. So it brings it down to 144. So to get the real number, you add it back on. So that 15,000 gets added into distribution. It then also has to go into other operating income. It's patent royalties is income. So it's money you get from owning a patent. Okay. During the year, land which cost 80 was sold for 167. So that's your profit on the sale of land, and it's included at 850. So don't worry too much on that. That's your that's what sort of working is already done for you. So we have to work out the depreciation then in the next working. Depreciation on buildings is to be provided at 2% straight line. So I'm going to do a little working on this, not for any great reason, but anyway, you don't have to do it as a working. So it's depreciation of buildings. Now buildings is this 760. So it's 2% of the 760,000, which is 15,200. So that's what the depreciation of buildings is. And it's telling us that that has to get split up 40% distribution and 60% admin. So it's 40% of the 15.2 for distribution, and for the admin it's 60% of the 15.2. That's 6080 for the distribution and 9120 for the admin. All right, so we'll go up there. So for distribution, 6080. And for the administration, it's 9120. That is for depreciation of buildings. Now, the 15.2, because you're revaluing buildings, that goes in there. I wonder what's the depreciation. Sorry, I missed out the accumulated depreciation. 81,300. That should go into that should go into revaluation as well, because you don't have accumulated depreciation when you revalue. So I managed to miss that when I was going through the list, so apologies on that. So the last part is the increase in the value of the building. So they've gone from 600 or 760 up to 850. So that's an increase of 90,000. And that'll give you the revaluation reserve. Okay, so that's that done. So that depreciation, just very important, the depreciation of buildings doesn't go into tangible as a minus, because buildings are being revalued to the 850. All right, delivery vans are depreciated at a rate of 20% on a reducing balance basis. So reducing balance means you depreciate on the balance, not on the cost. So at the moment, Delivery van's value is, again, I'll just do this as a working. It is going to be 20% of the value of the buildings. So the value of the buildings is 280 minus 116. So that's 164. And that's 32.8. So again, reducing balance can come in anywhere. Reducing balance just means depreciation of the leftover amount, not the cost price. So that 32.8, that has got to be a selling and distribution expense. So 32.8 on our first page. $32.8 there, and then for your fixed assets, it would be minus 32.8 here. Okay, so that's that working done. That would be sort of new, but that's very, very easy. Reducing balances is key concept in accounting. Working 7. The company is being sued. It's unlikely they're going to have to pay out, so you don't do anything with the 100,000. If it was likely, you would go into creditors and we'll go into your profit and loss account, and it will go into capital and reserves as a contingency liability, but it's not going to be paid out, so you don't have to worry about it. The second thing is the company has received an invoice for legal fees, 5,000, which must be provided for. So it's provided for, it's not paid. So legal fees are an expense, so they're an admin expense. They will then be a creditor because you haven't paid for them. Okay. Next thing then, on the 31st of the 12th, Capital PLC entered into a contract with Stewart's Limited, a construction company, to build an extension to its premises at a cost of 400,000. It also intends to carry out improvements to existing premises, cost 120,000. Now, I've never seen that before, so I'm going to just look further down and see if there's anything in the notes. And you see there's a capital expenditure commitments note. So this here, number 8, is going to deal with number 4, because you don't have to do anything in the accounts. It's something you're going to do in the future, unless it's going to be loss-making enterprise. So that is that. We've got everything in. We've everything in twice. We just have to start totaling everything and start throwing the numbers in. So just total everything first. Oh, sorry. I'll go to, so I'll total these very, very briefly. That's our process of how we go about doing the question. Again, for you lads, don't bother writing the words. There's no need to write the words. They understand where the numbers are coming from. This is just for me, for the sake of doing these notes. Okay. There shouldn't be said anything that I've left out. I hope there's anyway. I will probably, I'm going to open up the market scheme myself just to make sure, because I've obviously gone through this very, very quickly. So that should be everything in. So we're just slotting through our numbers. Just bear with me, I want to get the marking scheme open. So cost of sales then 118,600. So your gross profit is the two taken away. Distribution 197,880 and 267,120. And your other operating income is 82,000 plus. So just do that sum to get your total. So gross profit minus expenses plus other operating income. Add on your investment income, add on your profit on sale of land, and take away your interest payable. Get 287,900. Take away your corporation tax. And that gets you to minus 238,500. There was no dividends proposed. So your retained profit for the year is 183,900. Take away the 42,500, and it's 141,400. Okay. Your tangible fixed assets 13. No, that doesn't seem right. What if I? It's 850 there. So 981,200. Just gonna have to check this in a minute. So that's your tangible. So that's 35,000, I think. 981,200. Okay, just add those together. Your debtors is 115,600. Your creditors, your dividends due is 0. Taxation due is 83,200. And your other creditors are 60,700. So we just take them away to find our working capital. You will lose marks if you don't write the words working capital. It's one of the few questions where you will, because this follows a legal process. Add that on, you get 134,7,900. Last couple of things. Revaluation reserve is 186,500. Add on your profit carried forward, 141,400. Add those together. And add your answer on to your loan. You get 134,7,900, which is correct. Okay, now here that is your two documents done in a 100-mark question. So I'm looking at the marking scheme here. Your first pages were 40 marks, your second page were 26. That's only 66 out of the 100 marks. So with the with the published accounts, you're getting an extra load of marks for the workings to the accounts. 24 marks for the workings to the accounts to bring you up to the 90, and then 10 for how the auditor safeguards the interest of shareholders, which we'll get to. So these accounts are just as important. So okay, I wonder is it possible to insert text? Just see. There it is. Excellent. So don't really know what I've done there. So text box. Should have thought about this a little bit before I did it. Okay, so right, apologies there. Okay, so I'll just flip that around. Okay, all right. So there's account prepared accounts. We've done that, and it asks you to also show the following notes: the accounting policy for tangible fixed assets and stock. So we have to say how we valued fixed assets and stock. So we look to our workings on fixed assets. So buildings, what happened? We only had two fixed assets. So buildings were revalued at the end of the year, and they're in the accounts at the revalued amount. So we write that down. Okay, so that's buildings. Do we depreciate fixed assets? We do, so we say that then. So fixed assets are depreciated to write off their value over their useful economic lifetime as follows. So that's what you write. So that's what depreciation is. So fixed depreciation is writing off the value of fixed assets over their useful economic lifetime. How are we doing it? Well, go back up to your workings. Buildings are being depreciated at 2% straight line. I suppose you better write per annum. Straight line basis. And delivery vans, they were straight line in pretty much every other question up to this point, but they're not now. They're 20% per annum on a reducing balance basis. So it's basically this working here. This working here. You're just writing that out in a short form process. That's fixed assets. Stock doesn't tell you what we're doing with stock, but all stock in accounting is valued on a first in first out basis. And the rule around stock is that you value it at the lower of cost or net realizable value. Now we know that ourselves from doing the question one, where you take away the cost price and add back on the damaged cost of the stock. That's why you do that. So that's working one. Okay. I don't know that of those marks, that's what 6 out of your 24. I'm looking at the market scheme here. Working two is you're working on operating profit. So what we write is operating profit is arrived at after charging the following. So operating profit, this number here, 208,400, is arrived at after charging the following. We know it's arrived at after charging cost of sales, distribution, administration, those expenses. We don't have to worry about the other operating income. What we have to do though is we have to show the costs that are not strictly cost of sales, that is not specifically the distribution costs and not specifically the admin. So it's arrived at after charging depreciation. So depreciation isn't mentioned in cost of sales, distribution, or other operating, distribution or admin, but it does exist. So the depreciation is 6080 plus 32.8 plus 9120. So that is 48,000. So it's your three depreciations from here. It's basically going to be all of your expenses, bar distribution and admin. We're going to have to lay them all out. So we're going to write it's the operating profit is arrived at after charging depreciation, 48,000. Patents amortization. Now I know that one is included in my cost of sales. So patents is normally not cost of sales. Cost of sales is opening stock, purchase, carriage in, and closing stock. So patents of 7,000, it would not be expected to be included. You would have to make that as a note. And then your other admin ones here, don't mind patents, royalties. That is just a correction, so that one doesn't go in. Your other admin ones do auditors, directors, and legal fees. So auditors' fees, directors' fees, and legal fees. So 16, 22, and 32, and legal fees for 5,000. So again, all of the things in the first three things except this patent royalties, because that's just a mistake. So patent royalties, if you remember, we're moving it from distribution to other operating income. It's not, it's just there to fix the error that was in distribution. So we include the two depreciations, auditors, directors, depreciation of buildings here, and legal fees. They're the things that we have to list out. We block the depreciations together. Okay, so that's that one done. Third one, dividends. So we're saying, what are we doing on dividends? So we have to say what the ordinary dividend paid was. And the preference dividend paid. So you can really have to do these in the reverse order. Preference dividend paid, we are told they're 8% preference shares. So you have to assume we've paid them all. So 8% preference shares, it's 8% of 120. Which is 9,600. Let me just say that is 8% or 8 cents per share. So the remainder of the dividends, which is 55,000 minus 96, is your ordinary dividend paid. Now you have to say what that is per share. So to find out what it is per share, you take the 45,400 and divide it by 600,000. that'll give you the per ordinary share. So it's 7.5 cents per ordinary share. So again, 45.4 divided by 600,000. Okay, so that's that working done. I'm just saying what the dividends per share are. No, it's not there, but I'm just going to put in the note on debentures. I won't actually ask it. You can get asked a note on interest, and you say what the interest payable is and the rate. Debentures, you would say what the when the debentures are repaid. Okay, I've got notes up on those, so just have a look at those. The capital expenditure commitments. Now, the capital expenditure commitments, you're basically just rewriting this out here. So, just give myself a text box. You're going to get full marks. You'd say the company has entered into a preliminary contract agreement with Stewart Limited to build an extension at a cost of 400,000. They also intend to carry out improvements to existing premises at a cost of 120,000 euros. Okay, so that's that working there. And then your last one is your tangible fixed assets. So that's looking at what has happened to your land and buildings and your depreciation of land and buildings over the course of the year. So working 5. Tangible fixed assets. You've got land and buildings. And you've got delivery vans. And you're supposed to show a total, so we'll show a total. So what we do is we show the cost at the first of the first, disposal or acquisitions, and the revaluation. They're basically the things that can happen to land and buildings, and that the end will be the cost at the 31st of the 12th. So really we look at what's happened. So what I'm going to do with land and buildings is we know at the end of the year at 850,000. Just going to put that there to start off with. All right. We know there was no change to delivery vans, so I'm going to do that one next. Delivery vans at cost were 280, so they started the year at 280. We didn't get rid of any, we didn't buy any, we didn't revalue them, so they end the year at 280,000. All right. Now we have to look and sort of work backwards. What did we start off the year with? So what do we know happened? We know we revalued them. Well, we know that they went from 760 up to 850. So we revalued them by 90,000. That even in our revaluation working, I can find it there. Yep, 90,000 is the increase. So they went from 750 up to 850. But we also know we got rid of vans, or we got rid of buildings during the year. So we got rid of land because it tells us. So during the year, land which had cost 80,000. So somewhere along, we sold land that had cost 80,000. So we have to work out what we started the year off with. So some number minus 80,000 plus 90,000 is 850. In effect, just look at the 7. Basically, what you can look at is the buildings figure here of 760. Add back on the 80,000 to that. That gives you 840. So 840 minus 80 plus 90 gives you 850,000. So to total them off, 1.12 million, 1.120 million, minus 80,000, 90,000, and then 1130. So we're doing the same with our accumulated depreciation. So what did we start off with on the 1st of the 1st? What did we charge for the year? Did we revalue anything? So transfer on revaluation. You could also have disposal. Just you haven't had disposal in years, so don't think I've ever had disposal actually. So then you have your accumulated depreciation. At the end of the year. So what do we have at the start of the year? So for delivery vans, we had 116,000. And for buildings, we had 81.3. What do we charge for the year? Well, they're in the question. They're in our notes. So we charged 15.2 on buildings. And we charged 32.8 on delivery vans. So then did we get rid of any depreciation? We got rid of all of the depreciation on the land and buildings. So those two added together are 96.5. We didn't revalue the delivery vans at all. Okay, so that gives you an accumulated depreciation at the end of the year. For land and buildings, obviously it's 0. For these, what will that be? 148,800. Which gives you 148,800 there. Okay, so then you're looking at your net book value at the start of the year and net book value at the end of the year. So your net book value at the start of the year, 840 minus 81.3, which is 758,700. For this, 280 minus 116, you're just taking your opening balances away from each other. And then the same for the end of the year, your closing balances. So 850 minus 0. And 280 minus 148,800. That's 131,200, giving you 981,200. Okay, so there are all your notes done. So the only other notes you could have would be on contingent liabilities. If you're asked on a contingent liability, that would be what you'd write out there. The company is being sued by a former employee, but that it's going to be all right. We're not going to be charged, or the company has been sued, and we're worried that we will be paid. It'll be basically whatever's written in the working. The only other one I can think of is the interest payable. And what you say is you work out what the interest payable on the loan is. So it's 7% of 39,000 and you just show what that is. It's not 39,000, 7% of 300,000, so it'd be 21,000. So that's really all you have to do. Or it could be asked on debentures, and you just say that the debentures are repaid in 2022, 2023. Okay, so that's all your workings. Your last bit, just for your 10 marks, we might as well do it. How does the explain how the auditor safeguards the interests of the shareholders? So the auditor works for the shareholders. So that's the first thing. Auditors work for the shareholders, not for the company. So auditors work for the shareholders by doing what? So they examine the financial statements, giving assurances that they give the statement for auditors is a true and fair reflection of the financial position of the company. What else did they do? So this is all about auditors. They sign off that the accounts have been prepared in accordance with the Companies Acts. So basically in accordance with the law and accounting standards. They can qualify accounts, and that means they can say that they don't give a true and fair reflection if they don't think this is the case. And they report to shareholders, not boards. Okay, so that should get you 10 marks. That's everything that they do. So I'm gonna I'll work back through a few published accounts. I realise I've no videos up online, so I'll be the first of a few. I'm going to try and get say between now and Easter, I'm going to try and maybe get the last 7 or 8, 10 years maybe of papers all up online, every question with videos on it if I can. I'm going to prioritize ones that are most relevant for you. So manufacturing accounts, sole traders for the question 1. So I'll do a couple of company accounts, but I won't put too much effort in. I'll get suspense accounts published, incomplete service, so on, tabular, I suppose, for you lads. And then I'll get to your questions 8s and question 9s. Anyway, again, please don't look at these till after mention. See you later. Good luck.